All right, this is one of my favorite lessons. I'm so excited to talk about the market history. It's going to kind of tie all the last couple of lessons together as we talk about how these actual numbers, I've been showing you a lot of hypothetical numbers as examples, but now let's tie it all together and talk about the market history. So I want to talk a little bit about just history in general. Let's look at these 20 years right here from 1980 to 1999 using the S&P as an example. So it's some very interesting things happening during this time. You got to remember that the baby boomers controlled the majority of the money for a lot of years. In fact, these baby boomers were typically getting pensions back in the day, right? And so not a lot of money was going into the market for retirement. A lot of money was maybe going into a little savings, maybe a little whole life. They didn't even have mutual funds, right? So the average person didn't invest in the stock market. You had to have a lot of money to invest in the stock market back in the day. So historically, the average person didn't really invest in the stock market until the 80s and the 90s when really the mutual funds got popular and they started to get rid of pensions and replace those with 401ks. In fact, the government jumped on board because they're like, hey, we get to decide how much of this money we're going to tax in the future because they're postponing all of the taxes until later. So this is a great idea. And Wall Street jumped on board because Wall Street said, hey, we just came out with these mutual funds. We would love to promote our mutual funds through your 401ks. And so the people at the time were paying really high taxes. So we're going to get into taxes in the tax module. But people were paying really high taxes at the time and they wanted to defer taxes until later. So it was like the perfect storm. A lot of things happened to where all of a sudden, all of this money, I mean, we're talking billions of dollars started shifting into the market. And you'll see exactly what that did to the stock market. I mean, look at this, 25% returns, 14, 17, 26 and 14, 12 and 27, 26, 34, 20. Let's keep going down all the way down, 19, 26, and 29. I mean, holy cow, look at that. I mean, look at those years. Just those years alone, the market was on fire. That's when people started to talk about, buy term and invest the difference. Nobody wanted to be anywhere but the market. Everyone was getting killer returns. Now remember, in our last lesson, we talked about average return versus actual return. The actual return, still not bad. It's a little less than the average, okay, but not too shabby, 13.9%. In fact, if you had $1 prior to this, in 1980, if you had $1 in 1980, right? By the time 1999 came around, you would have 1361. That's 1361. That's amazing, all right? In those 20 years, your money grew like crazy. This is why everyone has always wanted to invest in the stock market. However, knowing what we know now, let's take a look at the last 20 years. In fact, from 2000 to 2020. So that's 21 years total. And it started off with this whole dot-com crash. So we had the dot-com crash and we had 9/11 in there. Remember I talked about that in the last lesson where we lost 46% of the money. So our dollar ended up at 60 cents. Okay. Then remember, all of these good years that we had right here, we were just trying to get out of the hole. Remember, if you lose 50%, you have to gain 100 in the next year to get all your money back. Well, we eventually started working our way back and finally got back to our dollar. When, what do you know, lo and behold, 2007 and 8, the housing crash came in there and we lost 38%. But remember, it started in 2007 is when it started to crash. So it was like 56% from top to bottom. So our dollar turned into 61 cents again. So now all of a sudden we start to get all these good returns again, right? Oops, get down there, get that good one in 2013. And we finally got above our dollar, right? So 14 years later, from 2000 to 2013, we finally got our dollar back. Right around in here, they call it the lost decade. But if you factor in inflation, it's even worse. So it took all this time. Now think about it. A minute ago in the last lesson, we were talking about how we could save this, $12,000 a year for 20 years and have $1 million. Well, we're talking about 14 years and you're right where you started. Now, if that's not depressing, I don't know what is. Now, at the time of this recording, right? At the time of this recording, the market has been doing pretty well through 2020, right? So we've been getting a pretty good return and our dollar has grown to $2.56. That means that if we had $1 in 2000, it would have grown to $2.56, all right, in 2020. Now compare that to back here. On the last one, our dollar was $13.61, right? $13.61 compared to $1. $13.61 in that 20 years versus $2.56 in 21 years. Isn't that crazy? So things have changed a lot in these last 20, 21 years or so. And the focus has been on not losing. We want to eliminate some of these big losses. So let's take a look at what that would look like. So in this example, what if you never lost any money? And what if the most you ever earned was 8%? So here we have all these glory days, all right, of the 26 and the 13, and we're only getting 8 at the most. Right? But we have a limited return, we call it. We have a limited return in the sense that we're only going to get 8 on the upside at the most, but we don't lose during the bad years. Okay? If you don't lose during the bad years, then you don't have to worry about it. So look at what happens to your dollar. Look at the limited $1, okay, compared to this roller coaster ride. Right? In the last example, we looked at this roller coaster ride right here where the money, remember, it took clear down here to 2013 to get to our dollar. But if we only earned up to 8%, so we had a limited upside, we would actually be at $1.83. So we'd actually be further ahead, okay? And as the story continues, our dollar goes up and down. Our dollar finally grows to that $2.56. And in the example of our 8% cap or 8% maximum return, we would be at $2.69. Now, I'm not talking about any one specific investment or anything like that. There are investments where the floor is 0 and there's actually unlimited upside. Now, not unlimited upside on the S&P, but unlimited upside on other investments. And I have seen products personally that our clients have that have earned up to 20% and a little over 20% with that floor of 0. So now it wouldn't be the same as saying 20% here on the S&P, but the point is that you can, invest money without losing it. I remember a point in my career when it was buy and hold is dead was the big topic of conversation. And the idea was to hire someone to actively manage your money. That's another option, okay? If it's not buying a product that will do it for you, maybe you can hire someone to actively manage your money and help you to avoid those big losses. So instead of just buying an investment and letting it ride the wave, you could hire someone to try to avoid some of those losses. Just something to consider. Also, Warren Buffett says that, most of these guys and gals don't know how to avoid, some of these losses. And everyone's trying to, follow the S&P as a benchmark. Seems like the S&P is a benchmark for a lot of investments. So he says, just buy the S&P. Just go buy the S&P index. It's going to save you some fees and you're going to get a similar return to what the S&P is doing anyway. In fact, what I'm showing you here is kind of like a best case scenario for a lot of people, because a lot of people are trying to move their money around and they're making the wrong decisions and they're actually doing worse than this. There's a lot of people that get out at the wrong time, they get in at the wrong time, and their numbers look way worse than this. Plus, we haven't talked about fees or taxes on top of this either. So a lot to consider, but just to kind of tie everything together with some actual data, some actual numbers. I was showing you some examples in the average versus the actual, but these are some actual numbers. And to tie that average versus actual together, what would you rather have? If I were talking to you about two different investments, would you rather have an average return of 6.11 or an average return of 4.88? Interesting, isn't it? You would probably, until now, you would have probably said the 6.11. But knowing what you know now as you're gaining this knowledge about wealth, the reality of it is that the actual return was higher. Even though the average was lower, the actual was higher. Something to consider.